talk about within the fixed income space. It's part of our second quarter. That graphic is beautiful. I mean, for those of you on a radio, it's just a Pharaoh designed that.
Yeah,
you know,
yeah. I don't. That's not me.
We were at the Net over. The Net is the hotel next to our Queen Victoria Street shop in London. And John and I were over a beverage of our choice with Alex Webb, and he started sketching out the background for the real yield.
I wish you could hear the theme music as well. My heart starts racing every time I hear it.
Well, that's Pharaoh picked that out too. Yeah. I think it's a Clash song from like I think 78 or so. Right now, we're going to clash with how you got it wrong in the last 6 months, how I got it wrong in the last 6 months. Triple leverage all cash, that really worked out. I'll say futures up 18 and the continued melt up. Dow futures up 107. Look at those levels, 44.53 rounded up. Can I say 4,500 SPX? Bingham Chada, Deutsche Bank. Good morning on that statistic. 34,000 Dow. NASDAQ continues to go up. You're on the 3 trillion watch on Apple, right? You're going to mention that in the brief?
Oh, big time. We're going to talk about that. That's number 3, so I don't want to front run it. But, I mean, we'll see how these boards change at 8:30. Remember that the price action was really driven by the data we got yesterday and jobless claims and GDP. Well, this morning we have PCE coming up, a look at inflation.
We have a lot of data today. That's a summary.
A lot of data.
You know, get your Bloody Mary out. I know you're sliding into the weekend. Greifeld 8:30. Pay attention. Go.
8:30 PCE. Then we have personal income and spending figures. A really important look at inflation in this economy. And then we have UMich sentiment. We have, of course, you know, sentiment broadly among consumers. I'm really interested to look at the inflation expectations, though I know the Fed is as well. So we'll get those UMich numbers around 10 a.m. Also today, of course, we're on Supreme Court watch. We got the affirmative action decision yesterday. Now we're looking for the student loan decision. Of course, the Biden administration's plan to cancel student debt. Again, that impacts 40 million people potentially, so big ramifications there. And as Tom mentioned, of course, we are on Apple $3 trillion watch. The number to watch, the closing level, we have to get to $190.80. You can see we're comfortably above that. Maybe not comfortably, but firmly above that right now. Apple currently up about 0.7% in the pre-market.
Can I just point out that NVIDIA is 1.008 trillion?
It's amazing.
I mean, I don't know what's more important. You know, who doesn't own Apple? 3 trillion. Who doesn't have Apple? Like 11 products, whatever, in the house. But NVIDIA, which I really don't understand or know or get, you know, General Mills Cheerios, I get it.
Yeah.
Okay, NVIDIA, I don't get. It's a $1 trillion company. I don't know what to make of that.
And I got to pull up the chart at some point and look at what that was a year ago, because the rise of NVIDIA has just been amazing to watch, a really stunning move higher. And it seems like, I mean, you talk to a lot of people and they say that has more legs.
I think Pharaoh was like Taleb, he had call options on it. I think that's why he's got like a 6-week
That's why he can take those vacations.
Yeah, exactly. Tesla, market cap, less than NVIDIA. I never thought I'd say that. 816 gazillion for Car Musk company as well. Right now, we're going to get started as you recalibrate into next year. And yes, Katie and I will be here on Monday. Hope you attend as well. Tracy McMillan joins now with Wells Fargo, head of global asset allocation strategy. What's changed in your mid-year recalibrate, Tracy?
Good morning, Tom. Good morning, Katie. So what has changed mid-year is that we have continued to be very selective in our asset class selection and our sector selection, and in particular, you know, we have been very favorable information technology, overweighting that in our equity portfolios. We've just pulled back on that, thinking that that asset class now is probably a little bit overbought. We'll take some profits there. We're moving that into materials and energy, thinking that commodities prices here at relatively low levels could rise as we move through the rest of this year.
Okay, but this is really important, folks, because this is a sector analysis, and what you know is you pick 5 sectors and hope, as Wells Fargo did, you win in information. Technology, in energy, that's not good enough. Are you going to buy big oil? Do you buy middle grade oil, the old Anadarkos of the day, or independents out of Texas? When you say energy, what do you actually buy?
Yeah, so we're looking at the integrated oils. We're looking at really the broad sector as a whole because we think that that underlying energy price is going to support it, and that supply is going to continue to be constrained, and that demand will stay relatively firm. So we see oil prices moving up to between 85 and possibly $95 a barrel by the end of the year. So we think that that really supports oil companies across the board.
Do you pair that with buying the equities as well, in addition to buying the actual commodity?
We do. Within our portfolios, we look at various asset classes within equities, and we also have an asset class for commodities. So we do have a commodities position, and we're kind of taking that viewpoint on commodities through to our equities sector holdings as well. And within the asset classes, we've stayed up in quality, and we continue to do that as we look to the end of the year. And that's really benefited investors because it's been those higher beta parts of the equity markets, like emerging markets and small caps, that have underperformed large cap and those quality type holdings.
Well, as you look towards the end of the year and as we enter the second half and you take the temperature of this market, is it still a defensive tilt or is it time to go on offense? What are you playing?
Yeah, so we're staying defensive, and we do think that as we move through the rest of this year, we're going to continue to see that earnings recession that has already started. We've already had 2 quarters of negative earnings. We think we're going to see the 3rd quarter of negative earnings as we start to get earnings results here in the next couple of weeks. And we're staying up in quality. I mentioned that before, large caps over the higher beta sectors within fixed income. We continue to like quality over high yield. We just don't think the spreads represent the amount of risk that's there in high yield. So yes, stay defensive.
What is the ramifications if we get a higher yield set? I mean, I get the theory that if you have a coupon, you get a higher yield, you're going to pick up a further coupon while price goes down. That game plays itself, Tracy, as long as you can, and then it falls apart. Is a surprise for the next 6 months that we get price down, yield up enough where the carry on yield falls apart?
Well, that's one reason why we're staying shorter term, and we're barbelling with a short-term and long-term strategy and fixed income. So we do think that interest rates now are retesting a level that we saw back in March. And if you recall, when we hit these yields in the marketplace, we did start to see some disruptions. We started to see bank failures. Investors have written that off as idiosyncratic. They think that the Fed was able to take care of that. We're not so sure. We think as we move up into these higher levels of yields again, we could see additional disruptions. And so, we would stay short term, reap those 5% plus yields in the near term. But also, if we get up to 4% in the longer term bonds, we would be buying those because we think that as the Fed pulls inflation back to 2%, that 4% yield is going to look really good in the longer term.
It's going to be interesting to see. Tracy, I look at the recalibration, and the heart of the matter is there's a lot of people out there who weren't on the 7-stock juggernaut. What do you do if you don't own those 7 stocks? Do you take a minimum position? Do you just say, I have to wait for next time? What do you do with those glory stocks of the first half of 2023?
A lot of those are overbought in our viewpoint. However, we would continue to purchase those higher quality names, and a lot of those names are those 7 stocks that have performed so well. So we would look for better entry points, but you really need to be in the higher quality names, and so we would we would hold positions there, but not necessarily initiate them.
Tracy, thank you so much. Tracy McMillan there with some real acuity from Wells Fargo Investment Institute on what to do. I think what's great there, Katie, is people talk about 60,000 feet, economy. It's like bank CEOs where they go, what do you think the economy is going to do? Do I really care? And with asset allocators, it's like 60-40. And what you heard there from Ms. McMillan was the real acuity of saying, okay, we're going to lighten up on tech. And I think we're going to go long energy. And then it's okay, how do you affect that? And that's the hard part.
Yeah, and how do you affect that, again, across assets? I really enjoy talking to people who manage a multitude of assets because that's a two-sided trade. I mean, you can do it through the actual commodity market. You can do it through energy stocks. We know that there's been a bit of a divergence between those two, especially last year, but it's an interesting bet.
And what's interesting here, and we do this with the death of Harry Markowitz, who basically invented everything we talk about every day, the laureate dying this week at 95. Of course, one of the forces of the University of California at San Diego. And Markowitz would say, you got to diversify. And yet I was thunderstruck in the Brian Murphy obituary in the Washington Post, how he said, I wish I owned more stocks when I was 25.
There you go.
And that's a huge deal from this Nobel laureate that he would have said that a couple of years ago. I wish that I'd own more stocks. You're going to hear that a lot. A theme to say the least. Futures up 17. The Standard & Poor's 500 up a lofty 0.4%. We say good morning to all of you. Bloomberg Surveillance on radio, on television. Just lots to talk about. And I want to talk right now about an absolutely momentous day. For those of you younger, this is not a big deal. You can take it back to your viewing of Mary Poppins a few years ago. I think the movie came out, I'm guessing, in 1966. And you'd think, Katie, in the great bank scene there, David Tomlinson and Dick Van Dyke as the elderly banker, that LIBOR was in play. They were doing LIBOR when they were doing railways to India. LIBOR is actually pretty recent. It's back to the 1970s or so. And we're seeing now the end of LIBOR. Bloomberg reporting here that the final LIBOR fixings in Europe, they wear tuxedos for this, published, overnight. And these are the different tenors. This is one of the most famous charts in the history of modern Wall Street. I have huge pride that the team, Bloomberg Surveillance, lived this from 06, 07. I had the clearest memories of going back and forth on the day this blew up in August 07 with a leading firm CFO. We were talking about 4 standard deviation moves in LIBOR OIS. This is pure LIBOR, the 3-month, 90-day fix. The huge calm as it came down after Lehman, after Bear Stearns, was flat. Some of the angst of the last decade. And then with this pandemic, folks, the absolute surge in short-term interest rates. Stay with us with the end of LIBOR, because we have a jewel in this company, Ira Jersey and his team and Bloomberg Intelligence, and they will help you with the new LIBOR, which is SOFR. I think I'm pronouncing that right.
SOFR.
Did I do okay there?
That sounded good.
SOFR is what it is. LIBOR, the final days of LIBOR, extraordinary. This is Bloomberg. Good morning.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The UK is getting ready to make
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Discrimination still exists in America. Today's decision does not change that. It's a simple fact. If a student had to overcome adversity on their path to education, college should recognize and value that. The court has effectively ended affirmative action in college admissions, and I strongly disagree with the court's decision. Because affirmative action is so misunderstood.
The President of the United States, Joe Biden, they are on fire yesterday over the controversy of affirmative action and the statement of a 6-3 Supreme Court. Full disclosure, I should note that Michael Bloomberg published on this for Bloomberg Opinion yesterday, very much in support of the tone there you heard from President Biden. Mr. Bloomberg is a majority owner of Bloomberg LP, which not only keeps me and Katie Greifeld moving forward, but also Bloomberg Television and Bloomberg Radio. Catherine Greifeld is in for Lisa Abramowitz and John Farrow this morning. We'll be here Monday. Hope you're with us too. And to dive into this debate and do it in a Bloomberg surveillance fashion, we can go to Anne-Marie Horton, who's our Bloomberg affirmative action correspondent. Anne-Marie, you brilliantly lay out, is reported across the news organizations, of a footnote that Justice Roberts wrote that West Point, Annapolis, and Colorado Springs are different. They're going to have affirmative action, but any given school is not?
Yes, there's this carve-out, if you want to call it, for military academies to continue using affirmative action, race-based conscious program admissions provisions in these military academies. And the president made a nod to that. He didn't quite connect the dots, but was saying we have, our military is the envy of the world, and the justices are allowing the military universities to do this. Of course, this is because the military wants to make sure that they have diverse officers, not just individuals on the front lines, but they want diverse officers, and that's really where this stems from. There's going to be some criticism by the fact that there are still officers that are the U.S. military that don't come from military universities. You think of ROTC programs on campuses. So a tremendous amount of pushback, obviously, from this White House and the Democratic Party. But also that was an interesting carve-out and footnote of this Supreme Court decision.
Anne-Marie, I think for this decision, and of course for our international audience, this is a modest uproar across this nation this morning. Rather than do the rehash of everything that's out there, I want to focus on one small vignette out of this, and thank you to Abby Van Sickle, who I thought was brilliant on this in the New York Times. There are two black Supreme Court justices. To be polite, they don't disagree. Can we say that about a broad Latino and black community in America, Anne-Marie?
I think for the most part, what you saw from the black community, Latino community, the individuals like the head of the NAACP, is that they firmly agree with the liberal wing of the Supreme Court, that this should not have been struck down, that this just negates decades of precedent in the United States to make sure that when you are applying for college admission, that university campuses are doing their best to try to make sure that they have a diverse body. Coming out of this is, of course, everyone watching this decision yesterday. We know that universities already have been ramping up and gearing up for potentially having to go back, tweak, revamp their admission processes. But also, some of the legal experts we were speaking to last night on Balance of Power are talking about the fact that this just opens up a can of worms for not just universities, but everything else, especially businesses and corporate America.
And Katie, as it was with any major decision down the road, it's going to be extraordinary. But the partition here from Clarence Thomas to Ketanji Brown Jackson is absolutely extraordinary in the anger of the language, the acuity of the anger is something I'm not quite sure I've ever seen before, really back 50, 60 years.
And this was broadly expected, but you're right in that reading what these justices had to say was really stunning. And Anne Marie, you mentioned that, you know, this doesn't just affect universities, this impacts businesses as well. And if you look at some of the response, I mean, for one, you had the HR Policy Association basically file a friend of the court brief saying that its members rely heavily on colleges. What does this mean for the pipeline of talent going into corporate America when it comes to diversity?
Well, I think there's one thing we also should note, and a nuance in this, is that affirmative action as we know it has essentially been abolished by yesterday's Supreme Court ruling when it comes to universities. But there are other ways universities can make sure they are still recruiting from diverse backgrounds, especially Black Americans, Hispanic Americans. You know, in the opinion, they did talk about the fact that students could talk about race in their essay and how that has impacted them. But it does bode a question of what does this mean, as all of these diversity programs have been set up for years and decades regarding this. And companies also, like universities, want diverse talent because diverse groups, many think, obviously bring diverse thinking, diverse workforce into a company. And what legal experts are saying is that potentially we could see more of this. And you already see in a lot of red states them really trying to crack down on any sort of DEI measures that corporate America is using or universities are using. And it's just going to get harder for corporate America to really navigate state by state what is allowed when it comes to diversity, inclusion, and even things like the environment, et cetera.
A lot of work ahead for universities and for corporations, to your point. But let's talk a little bit more about President Biden's response, because speaking after the decision yesterday, he said that we cannot let this decision be the last word. But what options, what can the Biden administration do here?
Well, they're pointing to the Department of Education, but there's really not a lot they can do unless, of course, they were able to get Congress on board. The other thing they could do, which the president then said in an MSNBC interview that he would not do, is, of course, potentially try to stack the court, add more justices. And he said that would be a mistake. But the president did call this current makeup of the court, which yesterday on ideology lines, you saw the 6-3 and then a 6-2 on the Harvard case because Justice Ketanji Brown Jackson recused herself, is you see what he is calling a not normal court. But this is going to be a huge debate going into 2024. We saw a lot of outcry yesterday about affirmative action, but many are pointing to the fact that Democrats were able to really keep their majority in the Senate, even pick up a seat, and there wasn't a wet rave in the House because of abortion as well. And then today we're going to get student loans and potentially affirmative action decision, a LGBTQ decision as well.
Emery, one final question, and this is just because you're so well read on the American political experience. Do people vote in a presidential election because of their beliefs of Supreme Court dynamics? Does it really matter inside the voting booth or the write-in ballot?
I think it depends on what the Supreme Court decision is. We've seen that Democrats were not only able to campaign aggressively on striking down of Roe v. Wade and the Dobbs decision, but that likely saved them from a red wave when they were Democrats and the White House were dealing with very high inflation, because abortion really matters, especially to those independent women voters. And when you ask Republican presidential nominees what they're going to do regarding abortion, it's a difficult topic for them to answer because they know they do not want to ostracize the middle of society. Will individuals go out and vote on affirmative action? Potentially, this could be an issue for the youth vote that the Democrats really want to pick up.
Anne-Marie Horton, thank you so much, our chief Washington correspondent. And again, Katie, I guess, you know, I mean, the Supreme Court day starts like your day, 10 a.m., right? I mean, they get going about 10 a.m., right?
Yeah, that's the time that we're looking for. My understanding is it doesn't necessarily have to come at 10 a.m., but that's when really the Supreme Court watch starts. And as Anne-Marie brought up, I mean, it's not just student loans. We do have that free speech and gay marriage ruling expected today. So it's a hefty day for the Supreme Court heading into this holiday weekend, you could call it?
I think you could call it a holiday weekend. And let's not forget that people like to bury bad corporate news late on a Friday into a holiday weekend. It is not a holiday Monday. Believe it or not, July 3 markets are open. They came to me and Katie months ago, I think it was 7 months ago, and said, you know, we'll give you the month of August off into the first week of September if you do July 3rd. We'll be here Monday. Hope you're with us as well. It's a bull market. Futures up 16.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance Equities, bonds, currencies, commodities are Fridays before 4th of July weekend. You are riveted to the markets, and we're thrilled you're here. Bramo, Farrow, gone. Greifeld in. Plus, Katie Greifeld. Catherine, I'm looking at the real yield, 1.66%. This is a changed landscape. And to break out, I don't know where the level is, 1.70, 1.71 is a ginormous deal for the stock market.
You think it would be. I mean, you remember back when the 10-year real yield was negative 1%. Everyone was saying that's going to keep this bid into growth going. Now you look at where it is now, and that bid for growth stocks, it's still there. So we'll see. But really interesting moves along the curve, especially in the belly. If you look at the 5-year, I mean, I had talked to a lot of bulls on the Treasury curve, that middle point, and it looks like it's not working out, at least for today.
Well, at least for today. And the question is do you see the high yields of the 2-year dissipate, or do you see the high yields of the 2-year migrate out to a new higher yield of the 5-year? That's a raging debate. Just on the data right now, 2-year yield 4.91%. Officially, I'm on a 5% watch on the 2-year. We've been there, but just for a cup of coffee. 10-year yield 3.87%. 30-year bond on that mortgage space 3.91%. The 30-year mortgage has not breached up through new tension. There's a raging debate about what all this bond babble does to housing. Ian Shepherdson, who was on, he's pretty negative about it. He says there could be a real impact in the housing market.
Yeah, you would expect there to be, and we'll see how that actually filters through, whether the housing market truly has bottomed or where we head from here.
Well, there's a resiliency to it. We saw that yesterday in that third look at GDP. In 1 hour, a raft, I say a Seattle slew of economic data. On the equity markets, and of course she starts where I should be. Farrow is lecturing me. He sent me a note from his third island in Italy. And he says, Tom, you got to splash in with the fam and save more. So I booked a Carnival cruise. That's where I'm going, and you've got an update on the stock.
That's amazing. He said that. No
He
kidding.
did. Splash in with a fam.
I'm going to believe you. Let's talk about Carnival, though, because it's definitely cruising higher in the pre-market. It got upgraded to a buy at Jefferies. It has a new street high for its price target. Jefferies bumping it up, I believe, to $25 from $9. So a big upgrade there. The reason why they're really thrilled with Josh Weinstein's performance so far. He is the new CEO. He took over last August. They say that he's had a real positive effect so far when you look at the sales boost, when you look at the marketing efforts. So that's helping Carnival out this morning, up about 3%. Not having a great day is Nike. Well,
no, wait. We got to stay in Carnival here. Come on, folks. This is important. I haven't had a vacation since Christmas. Okay, we're looking at a 4-day Western Caribbean from Miami, Florida, from 244 average. You sit by the engine room for that.
Yeah.
From 244 average per person, 2-person rooms. I mean, this is not Round Hill in Jamaica. This is people love this stuff.
You're not getting
right
me on that boat.
Have you ever been on a cruise?
No. Don't trust the ocean. But in any
cruises,
case.
Okay.
I mean, a lot of people do love cruises, and you've seen the travel stocks do really well. It's not just the airlines, it's the cruises as well. Should we move on?
Tough travel weekend. Let's move on. But
okay.
See how she said that Bramo just would have moved on. Katie's like, shall we move on?
Shall we move on? Let's talk about Nike. They reported after the bell yesterday, down 3% or so pre-market. The quarterly profit just missed expectations, but of course it was the outlook that investors aren't too pleased with. Full year revenue for fiscal 2024 expected to grow in mid-single digits, according to its CFO. Analysts were projecting growth close to 6%, so a little bit of a disappointment there, and you can see that in the shares. I also want to talk about Apple.
Got Apple in the brain.
I mean, it's the story of the morning. We are on 3 trillion watch. Again, currently where it's trading in the pre-market, we're already there for its market cap, but really the news that caught my eye this morning was it got a new buy rating from Citi. This is amazing. They say that Apple has another 30% upside. This is a stock, obviously, closing in on a record market cap. And Citi says that Apple's ability to expand its margins is underestimated. Just really staggering.
You know, and what's important here, I can't remember if folks have made a banner up for this, but we're on a $3 trillion valuation. And you say as the juggernaut, when is $4 trillion, as Dan Ive at Wedbush has talked about? I did the math this morning. You can do this on the Bloomberg Professional Service, folks. And I was shocked how soon on the trend of Apple of the last decade, if you extrapolate that trend out, where do you think we get to $4 trillion? Thanksgiving next year.
Thanksgiving 2024.
Like literally like in 17 months or whatever it is. We're watching the Detroit Lions with Michael Barr in Thanksgiving, and we're looking at Apple as a $4 trillion stock. That I had no idea it would be that soon.
Yeah. I mean, we'll see. Trend lines don't always hold, but I mean, you just look at the performance of Apple. Obviously, it's blown away a lot of skeptics who have said there's already a lot of good news in this price.
Shall we move on?
Shall we move on? Shall we go to the bond market? I think we should.
I think we should right now.
There's a big debate out there kicked off by Bill Dudley calling for the possibility of the 10-year Treasury yield hitting 4.5%. Then you have Subhadra Rajappa on the other side of SocGen writing, quote, that we expect yields to gradually decline over the coming year as we retain our call for a 3.25% 10-year Treasury yield by year end. The yield curve should gradually steepen, turning modestly positive next year as the Fed lowers policy rates in a recessionary context.
Subhadra Rajappa joins us right now. My head is spinning here on equities and even more so on bonds as well. Subhadra, the fact is a lot of yields are moving up here. I'm looking at the 10-year real yield in the U.S., and it is sobering. What are the ramifications to you and SocGen if we see the 10-year real yield break out to new highs?
Well, I think that the impact is going to be felt not just in the bond market, but broadly speaking in all risky assets, right? We're starting to recalibrate to a much stronger economy, but a lot of the data that we're looking at, like the first quarter GDP, the second take or the third take, is backward looking, right? So we have to be looking at forward-looking indicators. And if the Fed were to raise rates by 50 basis points or more, then I think that you're going to see that feed through even more sharply into the broader economy. So the forward-looking data has the potential to be meaningfully weaker if the Fed, continues to hike rates. I mean, our call is that the Fed would probably stay in and around, the current levels for the remainder of the year. It's not out of the question that they raise rates by maybe 25 basis points or even 50 basis points by the end of the year. But, that's only going to really bring the recession, forward, if you will. We have a recession penciled in for the first half of 2024. That still seems like the timeline that we're looking at. But broadly speaking, I think a lot of the data that we're placing our optimism on is backward-looking, not forward-looking.
Well, it's so important here, the dynamics. Katie Greifeld mentioned earlier the belly of the curve. Let's come in tight, not 5 to 7 years, but in that interesting 2-year to 5-year space. What is your belief that we'll see there? Do the high yields of a 2-year, 1-year space come out to high yields of a 4-year, 5-year space, or do we get relief?
I think that a lot of the repricing in the Fed funds market is going to be very much a front-end phenomena. That's part of the reason why we don't really think that the 10-year meaningfully rises above 4%. I think we get close to 4%. It's going to be a buying opportunity for bond investors that missed their first opportunity earlier on this year to go long bonds. But again, the rise in yields, at least in my view, is going to be much more of a front-end phenomena and not a long-end phenomena. And you're looking at the yield curve, the 2 cents part of the yield curve is back near negative 100 basis points or below. Again, that might be our opportunity to think about reinitiating steepeners in the bond market, because eventually the more the Fed hikes, the more the slowdown is going to be, and the Fed's going to have to perhaps adjust policy during 2024.
Subhadra, I am so excited to talk to you about that 2s-10s curve, over 100 basis points inverted. And you say that you expect the yield curve to gradually steepen, and that language masks a huge call, because if you expect the 10-year yield to sort of drop and then stay there, what does the front end look like? How much do 2-year yields have to plummet, and how much does the Fed have to cut to get there?
So that's really a tricky question. I think it's fair to say that the Fed could keep policy stable after getting to a certain level. But beyond that, I think that the Fed is very committed to keeping policy higher for longer. And this time around, with inflation, not just a U.S. phenomena, but a global phenomena, I think that global central banks are going to keep policy restrictive well into the first half of next year. So in that sort of context, it makes sense that the front end remains sticky and you don't really see that dramatic repricing lower in the 2-year part of the yield curve. That's why we're calling for a very gradual re-steepening of the yield curve. Typically, when the Fed pauses, 6 months after that, you tend to see the 2-cents part of the curve steepen out meaningfully. This time around, that process is going to be somewhat gradual. Also, for the 10-year, we only have the 10s getting to, say, 3.25 by the end of the year. That's not a meaningful decline from where we were at the lows of this year in 10s. Again, the decline in yields is going to be much more gradual across the curve in this cycle as opposed to in past cycles.
So what gets us back to positive territory on the 2s 10s curve if you have the 2-year kind of anchored? I mean, what has to happen then at the back half?
So we will, I think, eventually get to positive territory, but it's going to be perhaps in 2024 and not in 2023. We have the 2-cents part of the curve, steepening out, but getting to only anywhere between, say, negative 15 to negative 25 basis points, by the end of the year. So the steepening is going to be, much more gradual. But broadly speaking, you look at the broader economy, you are going to start seeing the market respond to higher interest rates. We did see some improvement in the housing market in the last couple of months. If you start seeing 10-year yields starting to get towards 4% again, and mortgage rates start to rise, you're going to see that impacting the housing market, and the broader interest rate sensitive sectors of the economy are going to respond to higher interest rates.
Subrata, thank you for the brief. Really look forward to talking to you into 2023 here on the dynamics of fixed income. Subrata Rajappa with SocGen. Futures up 15 right now. NASDAQ, I'm going to say led by Apple. To be honest, I'm making it up. I haven't looked, but Katie's been beating me to death with the Apple Watch all morning. $3 trillion. Standard & Poor's 500 up 0.3%. We say good morning to all of you. Bloomberg Surveillance on radio, on television. Katie Greifeld in for Lisa Abramowitz and John Farrow. They're going to be back. Bramo, I think it's back like the 15th or whatever.
Perhaps.
And Farrow, he wants to get back for the opening of Premier League, which I think is like August 20. But we'll have to see on that as well. You've got the real yield this afternoon. We're making jokes about it, but let's discuss this, folks. It's important. Amy, if you could give me the Bill Dudley quote from yesterday. How do you make up a guesstimate on a 10-year yield? You make it up in terms of pieces. And of course, the PhD from Berkeley absolutely nails this in his critical essay yesterday. I'm going to read this in its entirety for radio. Suppose a Federal Reserve short-term interest rate target adjusted for inflation, the real yield, averages about 1% over the next 10 years. Inflation averages 2.5%. I think we can agree on that. And the bond risk premium, which is the noise out there of risk, is 1 percentage point. Well, you sum that up and you get 1 plus 2.5 plus 1, and then you waltz yourself out to 4.5%. That's not outlandish, is what Dr. Dudley was saying.